All right. Well, let's go ahead and get started, everybody. Good day, everyone. My name is Steve Jackson. I'm the Senior Vice President of Strategic Development and Channel Sales here at PrimePay, and we want to welcome you to one of our regular monthly broker webinars that's all been part of a series of webinars that we have put on for the last, 8-9 years. So welcome. We are thrilled that you have taken time out of your busy schedules to sit with us today. Yes, folks, it is August here already. It is moving quickly. If you haven't gotten into all those summer activities, get them done. Few weeks left. But I know you will do a good job there and get that done. So I want to welcome you to our webinar titled Our Annual Compliance Grab Bag Webinar. This is actually one of my favorite webinars that I get to do each and every year. We kind of chock full this webinar with a ton of just regulatory compliance, guidance types of issues, concerns, things that you can immediately take back to your clients. But we do so in a lightning round fashion, okay? So I'll say this again before I get started, but you're gonna wanna have your pens, your paper handy, ready to go, because I will kind of rifle through in a lightning round fashion a lot of key issues here today that we ultimately believe are very pertinent to your clients, things that your clients and businesses are dealing with on a regular basis. Let's go ahead and set a little bit of the ground rules here for today. It is great to see so many familiar names on our webinar here today. We have a lot of folks on, because I know that ultimately you want to try to get your hands on some of this great content, comprehensive content, and be able to communicate this to your clients. Because of the large volume of attendees today, we are muting everyone's lines, but the question box is open. So what I would ask is if you would go ahead, go into the Go to Meeting menu bar. There's a question box. Go ahead and type in your question, and I will do my best to at least review these questions at the end of our webinar today, because I'm kind of going through a lightning round of different ideas and thoughts. I may not be able to tackle those questions here until the end. Now, if due to time or the type of question that may come through, if I need to get more of our legal team and compliance team around it, we will absolutely get your answer back to you once this webinar is complete. So no worries if I'm unable to tackle your question here during the webinar today. Also, the first question that I do get is, are you recording this? Can I have a copy of the presentation? We do record every webinar, and we do post these on our YouTube channel, our Broker Concierge YouTube channel. Just due to this week, we will be posting this probably on Monday of next week. So just know that we've got an extra day there actually to get that posted, but that will be provided. We always provide some exclusive BC, our Broker Concierge partners receive some exclusive content, and that's no different. We have a great brand new BC, our Broker Concierge brief that we want to provide our partners here today. And you also will receive a copy of the slide deck, this one is very good because I know many of our BC partners will use this slide deck to actually meet and greet with their clients and talk about these key issues, of our day. So that should about do it here for the logistics. Again, lightning round here, just be ready to take your notes and go through. But there has been a precedence here, right, even before we get started, just in regard to why we do this webinar each year, but why we do a lot of the webinars throughout the year. A lot of our webinars are focused on compliance, regulatory guidance. You as a benefits broker are being pinged every day, week, month in regard to questions surrounding compliance, HR, benefits, a slew of different types of regulatory compliance items that you are being asked to solve for the client. And when you think about a business owner, as you look at that picture, before this lady as a business owner puts up this sign that says, "Come in, we're open," think about the strenuous, the arduous, the administrative tasks that this employer needs to perform before they even open their doors. And then, my goodness, opening your doors is one thing, but then the compliance and regulatory environment that impacts each business owner throughout and while that business is open is considerable. And so, one reason why we do this specific webinar is because we want to take a lot of compliance items and roll it into a short amount of time, because the top business issue that we see, that you see really from your clients, is centered around dealing with compliance or helping to mitigate their compliance items. And so today we're going to go through a lot, and ultimately it's in hopes that you can walk away immediately and talk to your clients about many of these particular items. So, as I mentioned, as you see here today, we have a lot of things in our lightning round of options, and it's going to go from Form I-9, which I think is important because there's an important deadline that's coming here in the next month that you should be aware of, or your client should be aware of. We need to touch on the good stuff, right, or just the stuff that's out there, FSA limits, HSA limits. But we also want to dig a little, not deep because this is lightning round, but definitely cover the new Fiduciary Rule and how that impacts HSAs. Non-discrimination testing is not going away. We've brought to you here today a very nice, succinct way to be able to inform and to be able to determine whether your clients are actually managing these non-discrimination tests appropriately. There's been recently, up until just recent, when the IRS has kind of calmed some of the confusion, but there's been some confusion around the tax treatment of fixed indemnity coverage. I know many of you, make these recommendations to clients, so let's understand that very quickly. There's been a recent update regarding reporting for QSERA and the W-2, so it's very important for us to kind of provide a lightning round of thought around that. Communication and disclosure is clearly, when you think about compliance, when you think about an employer that has employees, right, the need for disclosure and communication really important. So we're going to just I thought it kind of impactful based on some of the things that we've been seeing, just some additional language that you want to make sure that your employers are using for their COBRA notices. And then lastly is focused here on ERISA. I do want to focus on kind of this growing alarming trend in regard to delinquent filers, but understanding the enforcement mechanisms behind that to help those that need to file timely. But also I want to set the stage and prepare you for what's coming here for small group. There are things that you need to be aware of and start talking and communicating with your clients about in relation to ERISA and specifically filings for small group plans. Okay, so let's jump right into this. As I said, you can go ahead and type in your question as I go through the information here today. I am going to go quickly, but as I always try to do, I'm going to be very comprehensive as I go through these quick bullet points on many of these issues. So it's fun, right? All right. You can't fall asleep with this type of webinar. All right. So it was important for me, I thought, to bring up Form I-9. As many of you are aware, this is a common onboarding application, right, that each new hire is going to need to complete. Employers are obligated to, have not only this form completed, but actually even doing it in person. I mean, I need to see you, as you're doing this to confirm and validate. So very important form, and we're not going to go into those aspects here today. However, do your clients fully understand that there's actually a new version that must be used, and that deadline is fast approaching. So if you have clients today that are using the old version, they can, up until September 17th, but September 18th and after, they are going to need to use the new version, that is out there today. And so this is a brand new version. I'm not going to go into the subtle changes or information that's now on there. I'll allow you and the employer to kind of walk through some of that and some of those changes. It's not drastic, but just some key changes that were made. And so this new version is imperative. So that's September 18th. And I do want to reference, as with generally every bit of compliance requirements that are out there today that are generally penalties for non-compliance. Now, I'm mentioning these not as a scare tactic at all, but to understand that these penalties have increased, in some cases, double what they were prior. And so this first one for a fine per Form I-9 paperwork violation, these have doubled, 216 to 2126 fine per form. Fines for unlawful employment of unauthorized workers as a first offense fine is actually almost doubled to 539 to 4,313. And then a solid increase fine for unfair immigration-related practices, $110 to $1,110. All right. So again, guys, this is generally a practice, a habit that employers have been doing for some time, but they may not have fully grasped that this form has changed. So an opportunity for you to make an easy form of communication to your clients in relation to this new Form I-9 that must be used, again, 9/18 and after of this year. All right. And I'm just going to expose limits. We're not going to expose anything else. This is a family channel here, but we're going to go into flexible spending accounts and first kind of cover just where the limits are here today. Now, as you know, with FSA's transportation benefit limits, generally speaking, they are communicated. These limits are communicated around November, early November, somewhere in there, early November of each year. So they have not been communicated. So many of you are going through or beginning the stages for open enrollment, periods or planning here today, and in September, so just plan accordingly. I would expect that the Health FSA account would increase maybe a cost of living adjustment from $2,600 to something a little higher. Dependent care has not changed ever. So I would foresee no change there with dependent care, at least with what we see. And you might see, though, a small cost of living adjustment for qualified parking and mass transit, okay? And that's currently, for each account, is $255 per month. All right, as we think about the FSA, though, I did in this lightning round want to bring out an interesting little tidbit here, right? So van pooling, the ability for an employee or an individual who is taking mass transit, if they were going into more of a vehicle that seats 6 or more adults, they could actually consider that mass transit and apply this $255 per month toward that particular account. Well, as we look at how Uber and Lyft and, maybe others are beginning to kind of disrupt kind of that mass transit opportunity for everyone, they have introduced some of their own catchphrases, like there is now called an Uber pool, and a Lyft pool, all right, which comes to kind of full circle around to this regulatory description of a van pool. So what you want to keep in mind is that not all Uber vehicles or Lyft vehicles are compliant with the IRS standards for commuter benefits. Okay, as I mentioned before, a commuter vehicle that would fit under the definition, okay, of a van pool, they must have at least seats for 6 or more adults, and that's not including the driver. Okay, so how it works is this, and I have it on the screen here. Participant adds the transit debit card to the service provider's mobile app. So you go into Uber app and you add that debit card in there as a form of payment. You then would request a van pool ride, okay, from that particular vendor and choose the transit debit card as payment. So that's kind of a no-brainer. And then it's up to that service provider for Uber pool, okay, to send that compliant vehicle, all right? So, so it can happen, but that compliant vehicle must be or provide seats for 6 or more adults, okay? And again, not outside of the driver, not including the driver. So just know these are things that are different phrases, definitions, terms that are being used out there. Ooh, I use Uber pool. Oh, okay, do you? All right, so it's best to communicate how these accounts work and how a participant, if using it, would actually, actually, what do they need to do with their debit card? What do they want to make sure they're getting into when that Uber vehicle or Lyft vehicle shows up? One question does come up: when does that Uber van pool go into effect? It's effect now. So it is in effect. It is available. Now, Uber, that all comes down to the city. I can't sit here and say that Uber has it available in every city, but I think if you look at cities like New York and San Francisco and certainly probably others, that those particular options are available. But please see your vendor, those providers specific to that. All right, so good info, right? I mean, that's good information to share there for those clients of yours that do have those transit benefits. Very good benefit there. All right, health savings accounts. As I say here, kind of in the subtext here, the growth is evident. I mean, you certainly can't debate that over the last, let's call it 13 years, that growth in HSAs have grown exponentially. Even over the last few years, the number of accounts have increased by over 20%. The amount of assets within health savings accounts has grown kind of the same, similarly, as over 20%. And when you look at these accounts, over time, the rollover feature of HSAs have really enabled these account holders to build up a balance, in their accounts. And that balance is expected, right, to be available for current needs, but hopefully it's there for the needs in the future in retirement. In a webinar that we did earlier this year, we talked about what an individual may need just for healthcare in retirement. And if you look at just a female, just to provide a statistic here, a female that's retiring, normal retirement age, will spend roughly $140,000 to $150,000 through retirement just on healthcare cost. All right, so it's important that those who are starting an HSA, that they have an ability to be able to build that balance over time. Because as you look at as you look at the statistics of account balances today, those that were established years and years ago, their average balance is sitting close to $15,000. Still not near enough what is needed. Those that opened up an account in 2016, the average balance is sitting around $1,027, and only 4%, according to EBRI, who's provided a recent survey, only 4% of those account holders even had investments or had established that money into investments other than just cash. So they're just kind of using these accounts as a checking account vehicle. But you and I know that an individual truly, based on the needs of the future, they're going to really need to be able to save a whole lot more. So as the growth has been there, compliance needs are absolutely growing too, not just retirement, savings, healthcare needs, but the compliance around it. It's being scrutinized more and more. All right. So let's first cover the limits, and then we're actually going to go into a couple other key compliance items here as it relates to HSAs. So pretty simple stuff here. We do not see any dramatic increases in limits. The IRS has already posted the limits here for 2018. So we have that. So the minimum deductible for an HSA qualified high deductible plan will have to be $1,350 for single, $2,700 for family. So slight or small increases over the last year. Actually, the current minimum deductibles haven't changed here over the last, I guess, couple years here. So it's been a little while since this adjustment. For out-of-pocket maximums, you're seeing just a similar move for cost of living adjustment up to $6,650 and $13,300 for single and family for out-of-pocket. And contributions, we'll be seeing a slight increase in this coming year. Will increase by $50 for single, over $150 for family, up to $6,900, and then $1,000 for the catch-up. So if you're over age 50 and are able and want or need to be able to contribute more, you can, up to that $1,000 limit. Now, there are, and I'm not taking the time today because we're lightning round, but there are several Trump administration proposals that are very pro-HSAs. And even though we have seen a struggle here for any repeal or replace activity of ACA, the HSA provisions being discussed will probably live on no matter what occurs with Obamacare and any kind of repeal replace tactic. So note that probably here in the near future, we're going to see probably some relaxing of the rules of HSAs, but also an ability to contribute a whole lot more into an HSA. Okay. And so, one question that I see briefly here is on catch-up contributions. And the catch-up contribution was just that additional way that if you've got an older, more mature account holder, getting closer to retirement, they wanted to give them the ability to be able to add more than just someone that is age 23, contributing to an HSA. And so those catch-up contributions are just for those above age 50 and enables them to contribute just a little more than the rest of us, maybe out there of the younger set. All right. So those are the limits. This is a great slide that you guys can use. At least as you're talking to your clients, as you're talking to them about their open enrollment situations that are coming. Okay. We've got a couple key lightning round options here under HSAs that I want to cover. All right, so did you know? I thought this was a great did you know. A lot of plans due to the Affordable Care Act, right? We have changed at least the capability for now an adult child up to age 26 that can be covered under their parents' health plan. All right, many of these plans are HSA qualified. All right. But however, and so let's just take a parent, okay, they're employed, they're the ones that have the plan, they have their adult child covered under their plan. That parent is able to certainly contribute to their HSA, but if the HSA is in their name, because that age 26 adult child is probably not considered a qualified dependent, which most will not be, because why? Well, they're living in another state. they're not a dependent by any stretch, tax dependent or otherwise. However, they can be included and they're eligible to be enrolled under that plan. So things to note. That adult child, the expenses that they incur, you cannot take dollars out of that parent's HSA to cover those expenses. Those are considered non-qualified expenses because the child is no longer considered a dependent of that parent. But there is a way around that. Okay, as long as that adult child meets all the other criteria to be eligible to open and fund an HSA, which generally speaking they can be, they need to open up their own HSA account. But again, one thing to keep in mind, they can only contribute up to that $67.50 annual amount for family. Okay, that means in aggregate, the parent what they're contributing to their HSA, and then the adult child what they're contributing to the HSA. You can only go up to that family max between the entire group of people there. Okay, so great did you know, just something to think about, just a little nuance that drives us crazy. And so eligible, this adult child is eligible to be a part of the health plan, but they would need to open up their own HSA account in order for their expenses to be qualified. All right, let's keep going. All right, HSA. Another important reminder. We have a lot of employees today, older, more mature employees that are qualifying at that age 65 or are qualifying for Medicare. And so the general rules, okay, of the general rules of being eligible is that as soon as you are, entitled, okay, to Medicare, so you're enrolled, you are receiving those benefits, the individual becomes ineligible to contribute during any month which they are entitled to those benefits under Medicare, okay? So Medicare enrollment, so we know that from an HSA, for you to contribute, if you happen to be now entitled to benefits under Medicare, you can no longer contribute. However, in this third bullet, Medicare enrollment does allow coverage to be effective retroactively, even up to 6 months retroactively for Medicare enrollment. And so this employee, this account holder have been contributing to their HSA during the previous 2 months. They now are entitled to Medicare. It's retroactive. And what are we to do? because in effect, if that Medicare enrollment is now made retroactive, that covers those preceding 2 months where I've made a contribution to my HSA, those contributions are ineligible. So items to consider. First off, may not be the case, but hey, has the account holder, the individual, already contributed to an HSA during this retroactive period? Okay, I mean, if they haven't, no harm, no foul, all right? But if the answer is yes, which many times it is, right? Because the employee is just going about their business, they're making their payroll pre-tax contributions, it's going into their HSA. So if so, those pre-tax contributions must be converted to taxable, and it is subject to a 6% excise tax. So just out of the gate, if we just look at the facts and circumstances, okay, in the first 2 bullets, has the individual already contributed? Ooh, okay, yep, we have. So if so, what the general rule of thumb is, pre-tax contributions must be converted to taxable and subject to a 6% excise tax. Now, the pre-tax contributions must be converted to taxable, okay? But the excise tax can be avoided as long as those excess contributions are distributed before the tax filing deadline, okay, which is generally your April 15th deadline that would be out there, okay? So again, this is an important reminder. This impacts, it impacts virtually every employer and client that you're dealing with. And as you are coming into open enrollment period, you want to make a clear representation or communication about how Medicare can influence or impact the HSA contributions of that account holder. Okay? All right. Let's go here into the last item here as part of our HSA lightning round experience here, and it is around the fiduciary rule. Now, as part of our follow-up email to our broker concierge partners, we have created a brand new brief that is specific and is very comprehensive about this fiduciary rule. And so look for that as part of our follow-up email here today. It's very comprehensive, but I want to touch on just a few things here. The fiduciary rule had been talked about for quite some time, had been delayed. The Department of Labor here earlier this year, back in April, released their final conflicts of interest rule that was kind of associated with the fiduciary rules or a part of those fiduciary rules, and then made the final fiduciary rules final, which now have been effective here June 9th. And so for many of the conduct standards, they came into play here as of June 9th. The rest of, and I'm not going to go into that here right now today, but the rest of the remaining standards go into effect January 1st, 2018. All right. So a big question has come up because as the fiduciary rule, all the proposed regulations were coming out, and then the finals were shown. It really, for the first time, has included HSAs as part of this conflict of interest rule, okay? And so there's been a lot of some needed probably confusion around this from brokers, from employers, just on, well, wait a minute here. How does this impact me as a broker, as a benefits broker, if I'm just making recommendations about health savings accounts or trustees or, whom an employer may want to choose, what does that mean to me? Am I now a fiduciary? And so on and so forth. Well, the answer becomes, well, yes, it could. I would say probably not, based on how you all are making your recommendations for HSAs or to the employer. However, dependent on how far you go, you could fit into this rule. So some common things that I want you to just be aware of here as you're talking about HSAs, some things that you want to keep at front of mind, okay, at the top of your head. The first thing that I can make a recommendation on, okay, and I don't believe you all are doing this, nor certainly an employer. So think about the plan sponsor here, not just you as the benefits broker, but the plan sponsor. Are you providing a recommendation of investment advice? Are you telling the employees, these individuals, hey, you know what, I wouldn't invest in that money market fund. I would invest in this growth fund or buy this stock or this bond or do this, do that based on your objectives, right? You're probably not doing that. But one way to avoid any conflict of interest would be to do this. Do not provide a recommendation of investment advice, and clearly do not receive a commission based on the investment. Okay, that would be another clear sign. So it's kind of, do not stay out of the investment advice area, but I do want you to do the following. Okay, that does not mean that we want you to stop education, communication. We still need to provide good insight and content to these employees. So still do the following. Communicate the benefit. Talk about how the HSA account works. Talk about that there are investments. There are investment selections. Tell them about, how they can access funds, how they can contribute funds, and the benefits and the advantages and the pros and cons. Certainly go over all of that. So communicate the benefit. You want to make sure your employers are doing that. An employer is well within their means to be able to look at a specific bank or trustee that will be the best fit for their employee demographics. Hey, we've done a lot of due diligence and we're selecting this bank, as our HSA, provider. No issues with that. The employer wants to continue to provide literature and enrollment guides, educational resources. And again, I say, you can include, well, what are my options for investments? Fine, that can be listed, on pieces of content. No issues there. Have information about their portal access, but certainly any or all additional resources that's centered around education and ultimately helping to drive participation in HSAs. So the key things that I want you to know, you as a benefits broker, you're probably not involved as far as investment advice, but you clearly do not want to be providing investment advice because it will be a direct correlation with the conflict of interest rule and therefore would make you a fiduciary, which would then prompt more issues or at least more requirements in your shoes if you do fall in that category. All right, so great stuff. So that kind of completes our lightning round on HSAs. Some good information. More than probably between 40 and 50% of all employers today offer HSA qualified plans. So this impacts a great majority of your clients. All right, non-discrimination testing. We're going to keep going through this lightning round, and two words that I need to throw out there that you guys are sitting in a very wonderful spot to communicate and to advise your clients on. Non-discrimination testing is required, and it needs to be done annually. If there's two things going to be found to be discriminatory, right? Under the benefits theme, a plan is not going to pass non-discrimination testing if the highly compensated employees or the key employees are able to get more benefits than the non-highly compensated employees. And that I guess many times is called the contributions and benefits test. And you see that a lot, and I'll show that here on the next screen as we go into the type of benefits. So benefits, are the highly compensated getting more benefits than the non-highly compensated employees? And then lastly, utilization. That's right. It not only has to do about contributions, and let's look at your plan design. Have you created strong eligibility guidelines that it is inclusive of everyone? Are you providing more benefits to highly compensated than non-highly compensated? But it's also looking at utilization. A plan will not pass as of the last day of the plan year. So when should you perform a test? Well, at least do it before the last day of the plan year. But if you do it the very last day of the plan year, does that give the employer enough time, if there were issues in passing, to take corrective actions before the end of the plan year? The answer is generally no. So you do not want to do it as of the end of the plan year. So best practice is this. This is recommendations. It's not a rule, but the best practice would be perform at least, the test or one test mid-plan year, in the middle of the plan year. And this is generally what we do here at PrimePay. At the 6 and 7 month mark, we're actually starting the process. We want to see, if we perform the test now, what critical issues or challenges are coming up that would tell us that we're not going to pass this test, or are we failing today? If we're failing today, we need to make some changes today that will enable us to get into that passing side of things. So perform at least one test mid-plan year, and then really the final test would only be needed if you on the end, you just need to perform it as of the last day of the plan year, or at least maybe the 30 days prior to the plan year ending. That way you have enough time to make changes, if you again do not fail, or if you do fail one of those specific tests. So I thought what would be helpful here for you is to provide a list of the relevant non-discrimination tests, but to do so by benefit, okay? If I were to perform this webinar today and we went into great detail about how the actual calculations exist and how they need to occur, I'm going to tell you right now, you guys would sleep. You would be falling asleep here on me. So what's important is, as you see these headers here, as far as benefit type, across, as far as the test across the top, and then benefit type here across the left, it's important for you to be able to ask those specific questions to the employers who have these benefits if they have performed or are able to perform these tests before their year end, okay? So as you look here at the first three. The first is a cafeteria plan, or what we call out there a lot today, a premium only plan, a POP plan, your basic Section 125 plan. That carries 3 separate tests. So each of these tests here on the top tier, at the very top row, rather, each one represents a different test, and each test is made for a specific benefit type. Okay, so as you see here, the eligibility test actually occurs with every single benefit option that you have, and then the rest of these will filter through based on the specific account. So for a POP plan, there are 3 specific tests: eligibility, contributions and benefits, and then a key employee concentration test. Those 3 tests each need to be performed, and they each need to pass those tests. Okay, so if you think about a regular health FSA or an employer who has adopted not only a cafeteria plan, a POP plan, but they also have a health FSA, they have a dependent care account, then you're also going to have 2 additional tests for a health FSA account, and there's actually 4 different separate tests for dependent care. So if you look at this from a regular, an employer of yours who has a flexible spending plan, dependent care, pre-tax benefit accounts, right? Or they're pre-taxing their premium deductions. If you count those up, there's actually 9 separate tests that need to be performed, okay? And so there are some simple questions that can be asked here to your employer. Do you have the results of your test? And then just be quiet, all right? What you're gonna find is that many employers have not completed their test. And if they're in any type of an audit situation, they're gonna need to have the results in writing, okay? It's something certainly that PrimePay provides, but it's certainly something that you need to ask your clients. The last thing here, the last few items, and I'm not going to go through each one, group term life, they're actually, so if you've got a self-insured, type of a group term life plan. See, I'm in the lightning round, so I'm talking fast. You have the eligibility and benefits test for self-insured plans, so HRAs, but self-insured medical plans. The eligibility and benefits test are required for under Section 105. You see then for fully insured plans to the far right, it is currently not applicable for a fully insured plan to go through non-discrimination testing. If you all are aware and remember, it was back in IRS Notice 2011-1 that they have stated that compliance is currently not required, but it was something that had come up from the Affordable Care Act and has not been shelved or removed entirely. It is still actually shelved. It is sitting on the shelf, but just waiting to be used. But as of right now, fully insured plans, there is no non-discrimination test. And then lastly, adoption assistance, the eligibility and more than 5% owners concentration test is required. All right. So again, great opportunity for you to be talking about these specific requirements to see what has been completed and what's not been completed. And start that process mid-plan year. Very important. Fixed indemnity coverage. This is another good one here, right? Many of you today offer or make recommendations for voluntary benefits. One of those being fixed indemnity types of coverages as supplemental benefits, right? Employers are trying to search, and employees are searching for new ways to offer additional valued benefits. Why? Because they're trying to keep benefit costs down. No duh. We probably all have wonderful stories of, when a specific event has occurred, and because of this benefit, getting a fixed benefit amount has been huge to be able to get through that specific issue that they're having. So routinely, a benefit offering that is going to help these employees try to keep their benefit down, or the benefit cost down, they're going to offer supplemental health fixed indemnity types of coverage. So there's been some confusion recently in regard to tax treatment, and the IRS has, finally provided, I think, some clarity to that. And so I want to kind of cover that. So a fixed indemnity coverage is in the instance where we take our little picture of our construction workers here. We've got an issue of getting hit here, and they have an event that occurs, an unpredictable health event. And, examples can be they need a medical office visit, a hospital stay, whatever it may be, and they receive a fixed benefit amount for that particular event that occurs. So a couple things that I just want to cover, and we'll cover quickly. You have after-tax deduction. So if you have an employee who has enrolled in such a plan of coverage, if they're paying for that coverage with after-tax deductions for the premiums, the amount of the benefit is tax-free. So if you think about a lot of language that the IRS deals with in regard to tax treatment, they want to make sure that a participant isn't double dipping, right? They're not only pre-taxing the premiums, but now they're getting a whole pre-tax benefit when it's received, okay? In some cases, that happens and occurs, right? In an FSA benefit and so forth, maybe, but, this is this is a common occurrence, at least with these types of coverage. So after-tax deductions for premiums, no problem. The amount of the benefit is going to be tax-free. But where some confusion had surrounded itself was around pre-tax deductions. And the clarity that has been provided is this, that if an employee is taking pre-tax deductions for premiums, the result is the amount of the benefit, so that benefit received for that event occurring, in excess of the unreimbursed medical cost will be included in income. Okay, so an example, the employee receives a $200 benefit based on that coverage and based on that event, but the actual cost for that employee was $50 for that office visit. So in this case, $50 is going to be tax-free, but the $150 would be included in income. So this would be something I don't believe would be an employer responsibility to determine when that employee would go through their tax filing, deadlines and so forth. That's when this information would need to be provided. Oh, and you sit there and you're probably looking at me like I'm looking and thinking about you guys going, okay, yeah, right. They're going to catch that. They're really going to be able to catch that on their taxes. Hey, nonetheless, it will be an individual responsibility. And just note that if they pre-tax the premiums, that the amount in excess of that specific expense, unreimbursed medical cost, would be included in income. Okay, lightning round. We're continuing here. I told you, you guys are giving some great questions here as well. But I'm going to keep moving here, and hopefully maybe I can address a couple of these here at the end. We'll see. The QSERA. Everybody knows that at the end of last year, we had this wonderful new option for small employers that if they no longer could offer a group health plan or could afford it, could not implement or offer one, that they now would be able to offer a benefit through the Qualified Small Employer HRA. So you guys all understand the definitions. An employer who is considered a non-applicable large employer, generally those under 50 lives, full-time employee equivalents. And as long as they're providing no group health plan, just in those general themes of eligibility, the employer would be eligible to offer a Qualified Small Employer HRA. This benefit, it is a benefit that is provided to each of those eligible employees, which could be used to pay for individual medical premiums and unreimbursed medical expenses. Huge, awesome, wonderful benefit, right? I mean, an opportunity here, the cost for that employer to be able to provide a group health plan may be outside of their means. But you as a broker come in and is able to immediately say, well, all right, I mean, I want the group health insurance business, but here's another option for you. Here's a way for you to provide a benefit to your employees. And it actually provides you a great opportunity to get your foot and maybe whole agency in the door to certainly provide a lot more things to that company. The maximum benefit, it's prorated each month, is $49.50 single, $10,000 family. And we all know that the tax-free benefit exists as part of this HRA, okay, under Section 105. And as long as that employee or individual has or is covered under minimum essential coverage, that benefit that the employer is giving them through the QSERA would be tax-free. Now, under the compliance aspects here for today's lightning round is documentation. The IRS, as of today, has still not come out with their final guidance on the documentation required. Okay. Now, here at PrimePay, we understand what specific statutes of Section 105 that pertains to a QSERA and not. So here at PrimePay, we are providing a full plan document, full summary plan description. I mean, we've got the full documentation that's needed, but the IRS has provided just some basic information right now for what an employer needs to provide. And the written notice generally needs to be provided within 90 days of eligibility or the beginning of the plan year. And it generally should list the following, the benefit amount, how the benefit impacts their premium tax credit if they're actually applying for a subsidy on the health insurance, under Obamacare. All right. And they also must list the tax consequences, right? You need to have minimum essential coverage in order to get that tax-free benefit. So just to understand, I mean, from PrimePay's view, we're providing that full documentation already. They're set, but the IRS is still confirming and still needs to provide some final guidance there. Now, where they have provided some guidance is in the W-2 reporting. And so I do want you to be aware that as of right now, this has just recently come out, that, and this is different from a regular or general HRA, this small employer will need to report the benefit amounts on each employee's W-2. And it has now been stated that it will now be put in box 14. You will use code FF as in Frank, and then you put that total annual benefit amount in that box 14. Again, this is for informational purposes, not necessarily taxed, unless the employer is providing the benefit and where the employee does not have MEC coverage. But I'd say that's probably not going to happen, but certainly it can, in which that benefit would be taxable. All right, good stuff, I hope. We now are going to go into COBRA, and I want to touch on this very quick. The health insurance exchange notice, it's often called the exchange notice, was something that had rolled out in, what was it, October of 2013-ish, or 14, maybe 13. The Department of Labor said it's required, but they're actually not enforcing it. But, COBRA is well enforced, all right? We've seen it through civil penalties and EBSA, which is the main enforcement agency for COBRA. And I wanted to just let you be aware, because we are catching it where employers that are not using an outsourced vendor may not be actually capitalizing on the language that is needed. The IRS has provided, or I should say, the Department of Labor has provided model notices where the employer can add information to the qualified election letter that would inform not only those qualified beneficiaries of their COBRA continuation rights, but it's also adding the appropriate marketplace language. And the primary language is there for a reason, okay? It's there to tell the COBRA continuant how they can obtain assistance with enrollment, the availability of financial assistance. It's going to provide contact information and certainly just general information, very general information about the products offered in the marketplace. Please ask your clients. I mean, certainly, again, if they're utilizing a company like PrimePay, we are providing that language. We are including the health insurance marketplace language within our notices here today and have been. But we have noticed quite regularly that employers are not performing this or have not added this additional language. And since COBRA is often very much enforced, you're going to want to make sure that that additional language is in there. I mean, think of this. Why wouldn't an employer want to have this information in here? If I can have that employee not take my COBRA coverage on my employer-sponsored plan and have them go on a marketplace, whoa, so be it. So get that information in the letter, because I think that will at least provide the options needed for that specific qualified beneficiary. All right, I told you I'm moving fast, right? All right, are you taking notes? All right, good. So ERISA, this is the last one here of the day. And I want to talk about, this is a little bit preparedness, but it's also about what I'm seeing out there and what PrimePay is seeing here in relation to ERISA. So two things that we're covering: small plans, kind of an alarming trend, okay? And maybe some ways for you to certainly get ahead, of that. All right. The first is this, and this is really under the phrase or the wording preparedness, okay? Getting prepared, all right? So what we have here today is for some time, we have had a small plan exemption for 5,500 filing. As you guys all know, even a small employer that is offering a health and welfare benefit plan, they are subject to ERISA. They're subject to the ERISA disclosure and communication requirements. You need to have a plan document, summary plan description, so on and so forth. You must produce a summary of benefit coverage notice, all of those things, okay, that fall under ERISA. But, or however, they were not required to file Form 5500, all right? So what the proposed regs are is, and what it's stating, and this actually came out last year, and so we've now moved a year closer to when this thing can come into full action. But it is actually removing, or it's the elimination of the small, fully insured, unfunded, or combination of unfunded and insured welfare benefit plan exemption. This would require that a small employer, just like a large plan, would need to actually file 5500. Also, within this information was the new addition to a new schedule, Schedule J. And within that, it is going to require an employer to actually add a lot more detail than they normally would. And this would even be for a large plan as well. So this isn't just because of the small employer. This would now affect large plans. Large plans and small employer, well, large plans are going to need to list the complete number of participants, dependents, COBRA participants covered under the plan, the type of plan coverage offered, plan funding arrangement, claims data information. Woo, we need another webinar for that one. And compliance with other applicable federal laws, okay, that will be in place. Now, for large plans, they're going to have to complete the whole thing, okay, under Schedule J. Small plans are going to be asked to supply answers, but it will be more to a limited number of those questions. Nonetheless, though, small employers are going to need to comply. This would begin with 2019 plan year filing. So you say, Steve, seriously? I mean, we still have some time, right? Well, you do. But that's where this preparing needs to come in. So why? Why should you start talking about this? Because what we find is that many small employers have not complied with the basic ERISA health and welfare plan requirements to begin with. They don't have a plan document for ERISA. They don't have a wrap plan for, all of their health and welfare benefit plans that they offer here today. They don't have the summary plan descriptions. They're not providing them to their employees today. So the bottom line, when this, or if and when, this could be delayed, but, who knows? The bottom line is it's going to ensure ERISA compliance. Guess what? When it starts to become in the public domain, 5,500 filings are in the public domain, there's access, small plans are going to need to comply. So it's going to expand data collection requirements. It's going to satisfy reporting requirements. It's going to force small employers to ensure that they are disclosing and driving summary plan descriptions to their employees. So you have to begin this conversation today and do it now, because it is something that if you can start this process today and getting them in compliance, when they actually have to file, that actually should be a probably smoother process for them at the end of the day. All right, lastly here, the alarming trend, okay? I think I've said this in a previous webinar, but I have, I have been very much surprised how many employers that are not doing their accurate or adequate or timely filing. And this is going to large employers today, okay? Not small plans, but your large plans. The Department of Labor, or EBSA, they come up with their statistics each year. This thing is increasing dramatically from year to year. There were over 22,070 delinquent filer voluntary compliance program filings. So that's where that DFVCP comes in. Were received in 2016. That means that employers have voluntarily said, ooh, I failed to file last year, previous years, whatever it may be, and there is no statute of limitations. And they decided to voluntarily file, okay? And when they do file, okay, through this voluntary program, it provides a mechanism for them to avoid potentially higher civil penalty assessments, okay? So it is important. They can save a lot of money, but it takes an employer to do it on a voluntary basis. You must ask the question with your large plans. Are they doing their appropriate filings? So avoid becoming a statistic, not you, the employer, your employers. A common error. Many employers are filing one 5500 form for multiple benefits, but they actually don't, or they have not created an umbrella document or a wrap plan in order to only file one 5500. They should have filed 4 separate 5500s, but instead they filed one. Well, those 3 other filings they're delinquent. Filing is for plans with 100 or more covered participants at the start of the plan year. So get with your get with your clients in regard to their plan years, and make sure that if you've got 100 or more covered participants at the start of the year, you're going to need to file. Now, again, that could only be for one plan. Maybe that's just the dental plan or the medical plan, but not dental, not vision, or whatever else they may have. So you do need to check them all. All right, but if you have a wrap plan, you're going to need to file for each of those. Also, review documents. We have come into several situations, even for small employers, where their insurance plan is held within a trust, which would create a funded plan. And so they may need to file based on that funding vehicle. So very important. I can't just overstate it probably enough, but that is very much needed. All right. So I've given you a tremendous amount of information here today in a short amount of time, and we've come up here to our final, since we're here at an hour, we're come up here to our final slides. What I hope you can do here with this, even this particular slide, is use this somewhat as a checklist, and you can certainly kind of tweak this however you need to as you're sitting in front of the client. But what you're going to want to do, right, is you're going to want to make sure with your employers that they are communicating and effectively managing the limits for FSAs and HSAs. Definitely review how an employer is handling their recommendations for HSAs. Make sure that there's not a fiduciary or conflict of interest situation that may be. Probably not, but just ensure that that is the case. As I showed you with each benefit plan type, there is a specific test that is going to need to be performed. Even with a, with HSAs where you're pre-taxing for HSAs, that's a premium-only plan, and you're going to need to perform a test for that premium-only TAN, and there's 3 tests that need to be run for that. There's a possible safe harbor rule in there, but still, those 3 tests would be needed. So make sure that that is being done and performed at least by the last day of the plan year, but best practice is the middle of the plan year. Remind your employers, start using that new I-9 form as of September 18th. Make sure that that is handled. You might want to have a conversation in regard to, hey, how are we actually handling the deductions for employees who are enrolled or participating in these fixed indemnity coverage or supplemental types of plans? Check that tax treatment. Make sure that communication is being made, if it is being made on a pre-tax basis. QSERA, wow, there's a lot of different things that come with that, but it's actually it's an easy plan to administer and to establish, but be sure that all requirements are fulfilled, and better yet, get your foot in the door. Don't think of a QSERA as a loss for your group health plan, business. It's an opportunity for future business and maybe some additional current business to occur. Not using an exchange notice, I'll say right now, most employers are not. They're not doing what they're supposed to be doing there. But COBRA is being enforced, and so make sure that that additional marketplace language is being added to those notices. And then lastly here, inform, right? Preparedness. Start talking to your small employers today as if they have to comply just like any large plan would today. That if they were to file a Form 5500, have they actually performed the additional ERISA requirements to get them to where they need to be for that specific filing? So let them know what is coming, and certainly engage large employers today on maybe some existing bad habits that they created here in the past, right? So if they've not been filing, don't just put your head in the sand, stick your head under the sand like an ostrich. I mean, totally, you need to attack it today. Maybe possibly the voluntary program is something that you need to go after. Woo! All right. That was a ton of information here that I've just provided. I see a lot of questions, but we are at our desired time here, and I won't take more of your time here today. But let me just cover some last minute details. I will get back to, I will get answers to your questions for those that I've not been able to answer here today. I do want to let everyone know that everybody will be receiving a link to the recording of this webinar. I think the earliest that we are going to be able to get that to you will be Monday, so just I'll let you be aware of that. For our BC exclusive partners, folks, if you haven't checked out our Broker Concierge program, you are missing out. We have a team of professionals here at PrimePay that are here to help build support of your agency and actually help drive business and information to your clients. And a big area of what we provide is the content. And as a BC exclusive partner here with us today, as an attendee today, we are going to be providing a new BC brief that does center around the HSA Fiduciary Rule. It could be something that you can hand to your existing clients. Very comprehensive, and I think will be very impactful in your conversation with them today. All right, and actually will probably allay a lot of fear with you and with your clients in regard to what you see there. We also will provide the presentation slide deck to you as well. Check us out. Go onto our website and learn a little bit more about Broker Concierge. Also, feel free to email us and call us. Call our team. Talk to our team members and get a better understanding of how we can help and support your agency through this program. I also want to remind you of upcoming webinars that we have. We're going to have our monthly broker webinar here September 5th. I think that's the first Wednesday in September, so look for more information. We actually have a really good one coming up here in September, so we're excited to have you come and join us. But you also have two important webinars that are coming here in August. We have an HR-specific webinar here on August 15th that we want you to invite your clients to. It also provides 1 hour of HRCI credit and SHRM credits to HR professionals that join that webinar. We also have a webinar on COBRA, very educational webinar that will be on August 23rd. These are client-based webinars, and we hope that you can take advantage of that to be able to invite your clients to that. And the link to the event page is there on the screen. With that, wow, lightning round. I hope you enjoyed it. I loved it, and I look forward to your comments and feedback. I hope you can join our next webinar, actually the next several here that are coming up, and really appreciate the business that you have entrusted to us here this year, and look forward to working with you as you head into this crazy busy selling season. Have a great August, have a great day, and this will conclude our webinar.